Good afternoon, everybody. My name is Dan Veru, and I'm the Chief Investment Officer at Palisade Capital Management. It's February 27th, 2020, and I'm coming back to you to update you since I last spoke with you on the coronavirus and the potential impact on our economy and on the financial markets. Clearly, things have worsened considerably since I last spoke to you. Both the number of cases of infected persons has risen considerably. There are now more than 82,000 confirmed cases, and almost 3,000 people have passed away. In the United States, we have 15 cases that have been confirmed. Most of those people have recovered somewhat, but it's very, very likely that that number is going to rise and rise considerably over the days and weeks. This is creating tremendous uncertainty in financial markets. And I think it's very important right now to have some perspective and to look at things with a little bit of context of where things might be going. Some have said that this could be setting up to trigger a recession in the United States and are making parallels to the 2008 financial crisis. I do not believe that to be the case right now, but it's something worthwhile monitoring. I think today's environment's considerably different, and I'd like to make the following points. First of all, the recent activity in the markets has really been almost unprecedented. Just since the 19th of February, the S&P 500 has dropped by more than 10%. So we're now down almost 10% on a year-to-date basis and are now in the position of qualifying this move in the markets as a correction. And it really has been driven solely off of fear of the unknown at this time. You know, the markets function properly when there's a balance of participants driven by humans and machines. Humans look at earnings and the prospect for earnings and make an assessment for what to buy and what to sell. But machines are just simply taking data as it comes out. What's very difficult right now is financial analysts really can't come up with models and tell you what corporate earnings are going to be like. So far, companies have lowered guidance, but they haven't even been able to quantify exactly what that new guidance is going to be. What that simply leaves you with are machine-driven trading strategies, and the recent liquidation in the markets has been breathtaking, certainly within stocks. Within bonds, the rally in treasuries has also been equally breathtaking. 10-year treasuries, which started the year at almost 1.9%, traded to 1.25% today, a very dramatic drop in a relatively short period of time. So why is this not going to trigger a recession? Well, if you contrast where we are today versus where we were in 2008, things are very, very different. First of all, while interest rates dropped back then from the activities of the Federal Reserve, unfortunately, the banks were not in good shape and weren't in a position to lend to either individuals or to corporations. You contrast that environment to today, the balance sheets of banks are extraordinarily liquid. They're at near historic levels of liquidity. And the ability for them to lend money to borrowers should be uninterrupted in the current environment. With interest rates down so low, I think we could be setting up for a dramatic refinancing boom of both individual borrowers who own homes and want to refinance their mortgages, but also corporate borrowers who can now take advantage of lower interest rates. So far, the corporate bond market has functioned pretty normally, though certain pockets in the energy patch are showing signs of stress, but we haven't seen broad systemic stress where corporate borrowers couldn't borrow money. If interest rates stay where they are for some period of time, uh, I think we could see this being a real positive for consumers who already are in good shape but can take advantage of lower interest rates. It could also set off a housing boom too in the United States as people look to make purchases of homes because interest rates now have dropped. That affordability formula that you often hear about becomes more and more important. Um, I want to remind everybody when I chatted last that this is an election year. Uh, a lot of things happen during election years, particularly when there's an incumbent president. Um, uh, uh, Incumbents like to keep their job and oftentimes can utilize extraordinary tools to help keep the economy going. It's very possible there could be programs that certainly could cushion any sort of economic impact from coronavirus or COVID-19. Lastly, I want to point out that work is being done round the clock. I follow a lot of the healthcare companies, and many of them are doing tremendous work to find a vaccine and develop a vaccine for this. The CDC has laid out a timeline that I think is somewhat conservative, as has the Health and Human Services Secretary. But work is being done round the clock to not only find a vaccine, but to also work on medications that could lessen the impact for those who have been affected by this virus. And I'll also point out that we're coming into the spring season. We should see the activity peak out for this virus, and hopefully that will lessen its effects. Though I want to point out we are going to see this virus again show up next year, but that should give us plenty of time to have appropriate remedies for the disease. In conclusion, there's nothing more disconcerting than watching stocks that you own drop. We take that extremely seriously. But we've been through periods like this before where fundamentals and movements in stocks become completely delinked. I believe this is one of those periods. We're just in a panic period right now. I don't think we're at a bottom yet, but clearly we're getting much closer to that. What I would be looking for as signs of a bottom are some technical indicators. That would be put buying relative to call buying, spiking. It was beginning to move in that direction yesterday, but really wasn't at levels that I would call capitulation yet. But certainly it's moving in the right direction. I'd also be looking at other indicators. For example, if yields began to rise modestly on 10-year treasuries and all of the interest rate curve, that would also be a sign that the money that's hiding in bonds right now, at least at a minimum, slows and possibly begins to come back and recycle into stocks again. And then lastly, volume. Volume on the New York Stock Exchange has been extraordinary, and today it was even higher. It was more than twice the daily average that we normally see. Those are all signs that we're perhaps getting closer to a bottom. I'm sure I'm going to have a lot more to talk to you about soon. I plan on updating you on a more regular basis as we get through this crisis. Like all sharp drops in the market, it's very difficult to live through them in the short run, but over the longer period of time, they really don't mean too much. That doesn't mean that it can't create a lot of anxiety. And we respect the fact that we're managing your money and doing the best job we can to protect and grow your capital. Thank you very much. And if you have any questions at all, feel free to reach out to me.
The information contained in this webcast reflects the views of Palisade Capital Management, LLC, as of the date of its original broadcast, and such views are subject to change without notice at any time. All information provided in this webcast is for informational purposes only and should not be considered investment advice or recommendation to purchase or sell any specific security. While the information presented herein, including information obtained from third parties, is believed to be reliable, no warranty is made concerning the accuracy of such information. There can be no guarantee that any forecast discussed in this webcast will be realized. Consult your financial advisor before making any financial planning or investment decisions. Past performance is not a guarantee of future results.